Session, and in terms of the value going through the market, it was a monstrous session. $6.1 billion worth of stock being traded today, so absolutely massive for a Wednesday. If we have a look at the market, also coming in an 8-point range of the all-time, the 5.5-year high of 5,461 points, and we saw new highs being reached all across the market. We saw a yearly high for building materials company Boral, media company Fairfax, information technology and market-related company Computershare, and all-time record highs as well for REA Group, TPG, Domino's, as well as Navitas. In fact, if we have a look at lows, we actually saw a low for the Bear ETF, which of course aims to make money while the market is falling. So definitely a very bullish market, also supported by GDP numbers coming in ahead of expectations for that fourth quarter. It looks like we saw strong personal consumption numbers coming through, construction numbers, as well as public spending. So we're seeing 2.8% growth, which was slightly ahead of expectations for 2.7%, and all sectors trading higher with the exception of telecom as well as property. So all up, it looks like it was a day for risk assets and a day for growth. The significant thing about today's session was a huge amount of volume going through the market, and volume really acts like the speed pedal. So when you see $6.1 billion being traded through the market testing those 5.5-year highs, and you see a very positive performance across those growth sectors, it means that momentum is gaining ground. So I wouldn't be surprised in the next week to see that 5,461 points being broken. As John mentioned, in terms of Fibonacci resistance, the next is the all-time high that we saw for the market around that 6,800 point mark back on the 1st of November 2007. So that seems like a while ago. Of course, if you count the dividends on the Aussie market, the accumulation index has surpassed the high, but in terms of the ASX 200 benchmark, that's what we're watching as well.
What leads us there, do you think, Julie? If we're to get there, what stocks, what sectors are going to get us there?
Well, first of all, in terms of the earnings cycle, earnings do tend to move in cycles. In the last few years, we've been in this negative downgrade cycle. This half-year earnings season, we have actually seen an upgrade, and hopefully that's a multi-year cycle coming through, and it's usually a multi-year cycle. So in terms of the fundamentals, I think that's supportive of the market as well as valuations at the moment. In terms of this point in the cycle and what strategies do tend to work, this point in the cycle is where the large caps do start to look expensive, and it's more the medium and the small caps that start to gain a bit of ground. So we are looking at the mid cap and the small cap index to gain ground. In fact, in the US, we've already seen it. The S&P 500 overnight reaching an all-time high, up by 1.5%. But also, if we have a look at the Russell 2000, which does seem to focus more on those smaller cap stocks, we did see the Russell 2000 ETF also reaching an all-time record high as well. So we're seeing that on global markets. We're expecting to see the same thing on the Aussie share market, and instead of being focused on value, I think investors are going to be focused on growth at reasonable prices. So looking for that growth, and if you have a look at those stocks reaching those all-time record highs, they're not the cheapest stock on the market, cheapest stocks on the market, but they are certainly growing strongly. REA Group, TPG, Domino's, Navitas. Have a look at gold, often thought of as an alternative currency, and if you think of it as an alternative currency which gained traction during the global financial crisis when the US was printing money and you can't really print gold, well, the gold's major competitor, of course, is the US dollar. So when we do see times of safety, I guess the reason why we haven't seen gold really surging too much is that we have seen moves into the Japanese yen as well as the US currency during this Ukraine crisis. Of course, we've seen an unwinding of that risk now, and that's been bad news for gold as well as oil prices. So it does look like, unless we do see some more instability in the world, that we could see the short-term trade in gold coming to a close, and of course the medium and the long-term outlook really dependent on tapering in terms of the US, and that's really why the non-farm payroll numbers on Friday are going to be absolutely crucial.
Also interesting, Julie, we're starting to see IPOs. We saw the back end of last year a lot of interest in IPOs going to market. A big one that we've been waiting for some time, HealthScope ramping up.
I think this is an area to really watch, because as the market gains confidence, you're going to see those market-related stocks like Computershare doing extremely well out of the IPOs that are coming onto the market, as well as merger and acquisition activity. Now, at the end of last year, we saw a large number of IPOs coming to the market in December, and you know what? They've started off 2014 on a fantastic note. Nine Entertainment's up 19% in the year to to date. We've seen Vocation up by 26%. We've seen Covermore up by 13%. Now, HealthScope is the struggling pathology medical centre as well as hospital group. Back in 2010, they sold it for $2.7 billion. There's now talk of a $4 billion float that they've started the international roadshow here. And of course, the healthcare space, over the last 18 months, we've seen this area up by 40%, trading on PE multiples of about 25 times at the moment. So if we do see HealthScope coming to the market early on in the year, it will be the first test, big test of the IPO market. But of course, we're watching other IPOs such as Queensland Motorways, Medibank Private, which are also due to hit the market in 2014.